for those of you that watch this, you have an idea that this is where we always start. And you can see that, last week we were at 14.88 million barrels a day of demand. Now we're at 14.547. So you can see we're kind of just splitting right in the center and tracking fairly close to where we were in 2022. Especially when you look at specifically the vehicle side, or I should say the mobility fuels. And a lot of that is being driven because, yes, distillate demand was slowing because trucking was slowing, but it was still very strong in comparison. And gasoline was a bit lackluster, but now you're seeing both of those play out. And in 2021, you had a bit more of the revenge driving. You had a huge surge that continued on the shipping front, and we just don't have that. And that's why we were expecting to push closer to 15 million barrels a day of demand on average. And instead, we're going to stay pretty close to 14.5, 14.6 million barrels a day. And that, again, is going to stay fairly low. So now when we start looking at the different levels, distillate stock had a draw of 800,000 barrels. We're 20 million below the 5-year. And as you can see, that most of that is being driven by Pad 1 with a drop of 13.8 million versus the 5-year. Pad 1 did have a small increase of 920,000 barrels. And then when you look at Pad 3, there was a drop of 1.87 million barrels. So when you look at the 5-year for Pad 3, you're seeing that we're running a bit low, but you might think, well, why is that happening? It's like because the ARB going into Europe is fantastic. You would be crazy if you weren't trying to sell anything and everything going into that market. And that's where it is. So the ARB is open. So you're going to export it. You're going to try to hit that market. And that's where you've seen some of those draws. And that puts us at a fairly disadvantaged space when you look at the piece, but it's not for everyone. Pad 3 is not disadvantaged. Like this chart is driven by Pad 1. Pad 1, the East Coast, is the area that consumes the most amount of heating oil. So it's not surprising to see that. Imports were down 48,000 barrels a day. Again, it was only driven by Pad 1, which continues to compete in the Atlantic Basin. And given some of the ARBs, it made sense for countries to export into Europe, not as much into the U.S. Europe is having some gas oil builds. That is going to start to eat into that ARB because, again, what the ARB will close as everybody tries to do in an efficient market. Make money. If money can be made, sell product into it, collapse the ARB, and then go to the next one. And that's, again, where you're going to see some of these different movements. And here's why it makes a lot of sense to run disty heavy. And here it is. Like when you look at the crack spread, I mean, we're at levels that we did not expect. This is not something that we were expecting. And the reason why we didn't expect it is because we honestly weren't expecting a voluntary cut from Saudi, and they came out and did it. And that that took a lot of heavy sour out of the market. That took a lot of medium out of the market. And now those are the crudes that are disty heavy. So the price of them have gone up, which is, again, you're going to have to offset that price increase with elevated crack spreads. Costs interest rates have gone up. Like there's a lot of cost that comes into this. So, this is just showing you the rudimentary financial piece of it, but there is something behind it. So the refiner isn't capturing all of that, but it's capturing enough of it to make sense. And that's why we see this movement, which is going to incentivize as much this decreation as possible. And here's another piece. So like Pad 1 had a small build, but you can see we are well off of where we're supposed to be and tracking much closer to 2022. Now, could we have a very mild winter again? Sure. But if we have a normal winter or even a slightly cold winter, this is going to become a huge problem. And Pad 3 is just kind of bouncing around where there's more than enough there. Obviously all the refining capacity or the lion's share of U.S. refining capacity is in this area. So they could make this up, but the market is telling us to export it. So we're exporting it. We have the storage available for it. And that's something that is going to continue until that ARB is closed. And that's when you start looking at demand internally, moving closer to the 5-year average. But as we've been saying, we're going to stay below the 5-year and have that bouncing back and forth because we're not seeing any big pickup in the trucking market. The trucking market is kind of flatlined around here. Obviously, Yellow did go bankrupt. They are in liquidation. They're in Chapter 7. So you have Old Dominion, which is going to pick up some assets, and some of the others. We have seen some trucking activity pick up a bit, but again, it's still not like it's going to bring us into 21, 22 levels. But you can see it's going to keep us at that 19 level, which is where we see that right now. On the U.S. rail traffic side, as we were saying, the uncertainty of the trucking market has put more on the rail. We did get a bit more of an increase on intermodal. We were only down 2.6%. As the trucking market is kind of balanced out a bit, we do see the intermodal volumes on rail coming off. Obviously, diesel coming back up is gonna squeeze the truckers a bit more, which is gonna keep people on here at a bit higher level. Total carloads were at 230,000 carloads, which is down 0% compared with the same week in 22. So again, kind of back and forth in general. So on the intermodal side, as we were saying, that was down 4.8%. Totaling total carloads of 2.6. I'm sorry, total was down 4.8. So again, you're not seeing too much of an adjustment, but we're not seeing a huge amount of help coming from the rail side, as that remains a pinch point. When you look at what's coming into the U.S., you can see things are a bit higher versus last year. But remember, things were really slowing down in 2022. So as they started off really tough comps, now the comps get a bit easier. So even though it looks like we're well above, when you look at the waiting berth, the waiting time, it's not there. So that's what when you look at freight waves, it kind of makes sense to see some of this balancing act. But that's where we're seeing some of these different mix points. But again, nothing showing a huge surge in demand. On the nat gas side, things are softening up a bit. You can see that we still have some heat and some extreme heat in Texas and Florida, but not much, not really anywhere else. And that's where you're going to see a fairly cooling degree days have come off. You've started to see natural gas come down. And again, that's going to eat into the nat gas side, less about some of the others. But here you can see that you're getting some cooling weather that's prevailing, especially for those in New England and the Northeast. It's been fairly enjoyable, at least in my opinion. Gasoline stocks had a build of 1.48 million. That's 14.6 million above the 5-year. When you look at Pad 1, small draw, Pad 2, small draw, Pad 3, sizable build of about 1.78. So again, you're seeing some of this balancing act. Finished motor gasoline was up 1.85 million. That's bringing us right in line with last year, and only 3.7 million below the 5-year. Which again, when you look at finished motor and then you look at blending components were down 370,000 barrels, which is 10.9 million below. But you're seeing some of these weird adjustments, and a lot of this is driven based on other oils and on NGLs. And that's where we're seeing the NGLs, where it's like, well, is it going into the petchem side? Is it going to the refining side? And we're getting a lot of these back and forths. And realistically, I think that this is just shaking out that we're fairly balanced when you look at supply demand in terms of what we're producing at these levels. So we will have refiners ramping up that will put more gasoline supply into the market. But how quickly we kind of ramp up is going to be driven based on imports. So we're 84,000 barrels a day above the 5-year. There was an increase of 192,000 barrels. As we were saying, we've been saying it because we saw the boats coming, and now they're finally hitting. We do have an increase of about, what we see is a fairly stable 850,000 barrels a day coming into the States. And that's, again, gonna put a little extra in there, which is why we've been saying at this point, you can see that there's typically a sizable decline that continues. And we don't really see that because we don't see a huge amount of of summer grades still being created. So typically, the reason why you have that drop is because guys dump summer grade into the market. They make sure that they can clear it out. They start making winter grade, and you're not seeing a huge shift, which is the interesting piece between blending components and finished motor gasoline, which is why we see a bit more of a sideways move, and the comps get easier, which is why we think that things catch up fairly quickly. Especially when you start looking, again, blending component side, a bit of a sideways move. Typically you get kind of that sell-off, but there's been a bit of a balancing act at this point, which is why, we don't see this big drop that we've seen in previous times. Especially when you start looking at the global market. North America had a bit of a rollover in terms of driving demand. We do see that rolling back up. This was not something we were expecting. We thought we were going to hold the line and stay right where we were prior to the drop in July 4th, which is that U shape. Instead, it started to come over. Europe, we saw that flatlining a bit higher. You can see it's continued to degrade. And then Asia Pacific continues to remain in a fairly tight range. So according to Gas Buddy, this on the previous week, as we talked about, EIA modeled 8.8. They modeled 8.93, fairly close. But then when you look at the activity so far Sunday to Tuesday, demand is up 1.8% from last week, and then it's 3% above the rolling 4-week average. So again, it's kind of getting closer to that 9.1 million barrel a day. But it's going to be difficult to go much above that, given the fact that we've had schools starting back up. We're past the peak. Typically we look at it as like July 4th, August 15th, but August 1st is really where you start to see schools starting up, which is why you start that bit of a decline. And then when you look at where gas prices are, they went from $3.50 to $3.78. That's a sizable jump. When you look at diesel, diesel went from about $3.75 back up to about $4.07. So again, you're seeing that pressure, and this is why we talked about inflation. When you look at energy inflation, that's going to keep things a bit bumped, and that's again why we see the Fed not pivoting too soon, because we've seen core or sticky inflation remaining elevated, and this is a huge chunk of flexible. And again, flexible is showing us that we're getting a bit of that acceleration. And that's why when we look at demand is falling flat. We do see this getting a bit closer to that 10-year rolling average of about 9.2, 9.27, but it won't go above. And that's where we've seen kind of the peak. And I think at least for us, this is a bit even less than what we were expecting. And we were expecting, I think less than the market. So you kind of get an idea of a bit of the, I guess you could call it shock. I don't think it was shocking. I didn't, just based on the macroeconomic data we talk about, this is what we were expecting. And here it is, playing out. Then when we look at propylene, 2.92 million barrels, 18 million above the 5-year, continues to soar at records, which is why, even though it makes it cheaper in the U.S., it also makes it cheaper abroad, which is why our exports continue to be strong. Jet had a small draw of 180,000 barrels, and as you can see, we expect a continuation back to about that average of about 1.6 million barrels a day of demand. Because on the 12-week rolling schedule, you can see we're starting to slow down a bit. And it makes sense. And again, it's just back to school, and you typically get some of those reductions that normally happen as we head into the end of summer. There was massive cancellations. So we saw some sizable cancellations, which again reduced some of that demand for jet fuel, reducing the demand for jet fuel. Again, reduces the need for continuous purchase, which is why we see, again, on the implied demand side, that continuing to slow. And as we were saying on the passenger side, 2023 in the U.S. is marrying 2019 almost perfectly. Eurocontrol continues to marry between almost a perfect split between 22 and 19, and we don't see that changing. We did see a bit of a rollover in activity on the eating out side. The U.S. continues to degrade. Now it's about 3 to 4% below normal. And then on a global basis, you have just some of the sizable reductions, which is, again, showing you kind of what is happening with the consumer, the pressure that consumer is under, and why we see some of that continuing to slow down, and why we see consumption, which is really the last strong point of the economy, really starting to give it up, especially when, and we'll cover it more on the show tomorrow, where we see some of those slowdowns when we're looking at the service side, which it's still in expansion, but slowing considerably. And that's something that we do think accelerates into the end of this year. So that's what we have for you today on this side. In the next segment, we're going to go deeper into the global market and some of the shifts that we're seeing in terms of just flows, especially from the refined product and crude side.